Hello all and welcome to my YouTube channel. Today I wanted to go through the systematic investment plan which we have been discussing over a couple of months back. Um, and I wanted to make a video separately out of that, which again further clarifies in more detail about how to go about with this approach. Uh, Systematic investment plan doesn't need a lot of capital, and the purpose of this plan is to invest for the long term by averaging down for the long term investments. So when you do it for the long term, you're basically averaging down, like what you can see. In my case, I've created this spreadsheet, and I'm basically showing you an ETF called as QQQ. You can invest in Vanguard. You can look for a list of ETF funds which make the index and which has at least given you an average of 8 to 7 to 8%. Uh, Sometimes certain years outperform the other years, and maybe a shorter duration of 5 years could give you an average of more than 16%. That was the case with QQQ. Um, so let me show to you a demonstration of QQQ, how the performance was overall during the last 10 years and 5 years. Um, so the 10 years, as you can see, is clearly 189%, which is like closer to 20. So closer to 18, I believe. And 5 years was like closer to, let's see, 14%. So 14 to 15%. So as you can see, QQQ has been performing quite well over the years. This is just an index fund which is excluding uh, all the financials. So basically, all the top Nasdaq 100 stocks are listed here, including your Amazons, Facebooks, etc. But it doesn't diversify the way how VTI diversifies. So it's all mentioned like in my previous videos where I've discussed more about these names, or in one of my future videos I will discuss more about it as well. You can do your own research and find more about these ETFs, but I've given you a simple for short forms, or what the fund is all about. If you are looking for growth and volatility, mostly SCGH or QQQ gives you that. So what I want to demonstrate to you is a SIP investment plan, how it performed during certain number of years. And what I did in this demo is, in this spreadsheet, is I took QQQ and I invested annually for that particular year amount that I just roughly estimated to be like 30K US dollars. And this need not be put in like uh, in one shot, but I just for a demo purpose wanted to see what could be the worst case scenario if I purchased QQQ at the highest price for that year. So for this particular demo, I just did that. And how I came up with these numbers are like, you can see the QQQ chart all the way heading back to the year 2000. And if you noticed here, for the year 2000, I have taken it from the highest point. Like for this particular point, the closing price was 97.87, so I entered it like 97, an approximate figure. So in 2000, similarly, the highest point, I believe for 2001, the highest point was somewhere around 41 or 40. uh, I have mentioned that also, like 2001 I mentioned it 57. Maybe I could have got it wrong. Probably, yeah. See, January was the highest point, so it was like 57. So that's what I noted down here. This all for demo purpose. So I took down the numbers or the price for QQQ for that particular year, which has the highest value, and I entered it. So I gradually invested this amount all the way from 2000 to 2008 to show you a demo. It's all the way till 2017, but for this particular demo, I broke it down like from 2000 to 2008 what happened, And what this I'm excluding the management fee and the dividend, which is negligible. I don't want to even talk about that for a second. It's just going to be 0.2% and dividend will be 1% or 0.9%. Let's exclude those two. Doesn't matter. That's very negligible. Dividend will overcome your management fee. That way you are saved. So that's the reason why I don't want to discuss. The more important point is the investment. What happened 2000 to 2008 and 2000. If you notice, these ones are highlighted in red. The reason being, these were the times where the recession or the stock market went uh, below the regular bull trend and was in a bearish territory or in a bearish market. And these corrections will happen. Not that it is going to be a bad situation. It would have happened for various reasons. These bubbles do burst. So once it bursts, don't think overall market is bad. There is no other alternate vehicle for an investment other than in through stocks or equities or through maybe a real estate, which is nothing but REITs for us. We can do that, or you can go invest in gold and see how you got your returns. That will be a separate video altogether. But I just wanted to talk to you about this ETF. So going back to the same point again, 2000 was the period where the IT bubble burst. So from 2000 to 2008, how did I do? Um, Total amount invested came to 270k. Okay, from here to here, 270k was the total amount invested. My average price from here to here was 47.56, and the quantities I purchased with that many dollar amounts were 6,312, and my total ROI was 300k, 300k something. I'm just going to say it as 300k. And what was the difference that I got between these? 30k. 30k I got, right? And now I'm going to divide this 30k for the 9 years that I invested my money in. It comes up to an average amount of $3,357. I just divided this amount by 9 years, so I'll get it per year. And what I observed is that I got a return of 11%. 11% return per year I got overall from a bubble which happened here all the way till the bubble, the 2008 bubble. So my investment wasn't cut into half. I'm talking only about this particular ETF fund. Okay. And in 2008 also I invested in the highest price range. Let's take a look. What was the highest point in 2008? Was 45.61, right? I mentioned that. You can see here, even with the highest purchase price of all these ETFs, right? I mean, particularly this ETF, I still managed to get a return by the end of the year of 2008, 11%. Okay, so now let's take a look what happened during the course of time. 11% to me is a good return. I'm not sure if it's a bad return if you did active trading. I don't think so. Active trading, I would have been able to even manage 11% that easily during those days. I think I would have been seeing markets, if it's not in a bull trend, probably getting really whacked. Because if you see the price action between these many years, like 2002 all the way till 2006, didn't do much. It moved slightly, right? Like the ETF pricing was very much like very not even volatile, you can say. It was very much stable and it was just like stagnating to some extent, and then it grew up in certain years, but more majority of the time it still stayed in its own price point and there wasn't much growth happening. So I still averaged a 11% return for my money. This might not be a huge amount for many people, but to me it is. 11% return on that money still makes sense. Then how did I perform from 2000 to 2017? I continuously still followed my systematic investment plan, and from 2000 to 2017 my total amount invested became 540k, and my return on this amount was 668k, which gave me total return for the last, uh, let's say, 18 years was 128k. For some, see, you can calculate this number in different ways, but this could have been even more. I would have got even a more return provided the price points that I purchased would have varied. Maybe I would have got it at a low, but I am still showing you the price where I purchased it in each year at the highest level. So with that itself, I still managed to get a return of 128k for the entire 18 years, and then the amount came closer to per year was $7,000 for 30k investment every year. If I divided it by 18, I made $7,000. So over the time, it even doubled what I initially put in, right? That's the power of compounding. So I got a return of 23% over the last 18 years with these numbers, okay? Today, it's even lower than this, but I'm still showing you in 2017, I would have purchased it at the highest point. But you can see the whole game here. What's happening is over a time, your money is still compounding. So don't think this amount is negligible or like is small. Beating a return of 23% is not that easy when you actively trade, because when you actively trade, you are not going to be in for the long run, right? So when you are getting in and getting out, maybe that day when you got out and you were staying in cash, and maybe the first when you went in cash, you would have missed opportunities when the market started hitting up. Maybe you would have waited for it to do the trend reversal, and once the trend reversal had happened, also you would wait for more days to confirm if the trend really happened, and by that time the market would have made it 6 or 8% move for that year. And when you participate, maybe your trade didn't work out well. So in order to avoid all that, if you had followed this methodology, even with a smaller amount, you can still average a better return based on the amount, based at the price that you purchased. Similarly, if I had done a video um, where I created a spreadsheet, where let's say from 2018 the crash is going to happen, because we estimated it to be saying like, okay, in 2017 market didn't crash, but I'm expecting the markets to start slowly crashing by 2018. Okay, so what I did is probably with the same spreadsheet, what you can also do is you can do the similar setups. What I calculated is I started pushing down the value of ETFs to 2000. I believe this was 2000 highs, so I changed it to 2000 highs, and I started reducing the price of my ETF. Simply randomly, I reduced it, but I never put it all the way above 2017. I wanted to make sure the recovery wasn't happening that well. So just an imaginary number, but below the last 3 or 4 years, QQQ funds what it performed. So even with that, right, overall when I took, my return was still 21%. 2002 to 2025, the return was like 20% still. Even during bad times, it became like 19%. But due to the power of compounding and averaging down, I still managed to get a return of investment per year of 19%. And if you noticed, my ROI is really picking up here. See here, it's like picking up each year. Um, like if you notice the difference here, you can quickly notice the difference. Like it was a difference of 30k, right, between uh, 1 year difference, that if I still held on to it, right, without coming out, even though it added up, it still gave me some more additional value. But this is how the power of compounding works. It doesn't necessarily have to be, you will have to double your money or triple your money. But if you had averaged down this in the right price levels, probably you would have got even more gains than what I'm showing you here. So if you had noticed in my ETF purchase, I am purchasing it on down days basically. Most of the down days I purchase very less amount with very less amount. This is the highest I have ever put, but generally I'll put even lower than this, like maybe $1,000 a week. for a month. Maybe I might put like few $500 or so. But you can see, right? And then when I average it down, I am still making good bet. Like overall, one of the asset classes is going to outperform based on the historical information. I'm not going to say that you know the future is going to look bright and all. I'm not going to come to a conclusion because of that I'm putting all my money into QQQ. No, I'm going to also diversify into VTI, which I spoke to you of also. And maybe I'll come up with a different video where I will compare all my investments, or like create a similar spreadsheet where I'll do my testing with VTI. How does it perform overall? But it all depends on, are you being invested or not. If you are not going to be invested for the long term, there is no point in following this methodology. And so you guys get the point what I'm trying to say here, right? Like invest for the long term and see how it goes. So with this, I'm concluding my video for now, and I hope you all enjoyed. Have a great day ahead. Thank you.